So the state of America is strong and there won't be a recession. The US economy is in a good place. At least that's the story Janet Yellen is trying to sell us. Now let's talk about the obvious. It has been almost 18 months since the yield curve inverted back in April last year. And when the yield curve inverts, the story says that a recession is coming. In fact, the yield curve inversion has foreshadowed all 10 recessions since 1955, with just one false positive. So why aren't we in a recession yet? It's because of all the endless deficit spending. The US government borrowed over $1.5 trillion in the first 11 months of fiscal year 2023, and that's up $600 billion from the year before. That's equivalent to 5.7% of US GDP coming from deficit spending. Now, this is money borrowed from the market at high interest rates. In other words, the US economy is being kept on artificial life support by Janet Yellen, but the cure is going to finish off the patient. And it's surprising that even Janet Yellen can't see the truth. She believes that the surprisingly resilient consumer has blocked a recession, and because of that, the Federal Reserve can keep interest rates higher for longer. The problem the Fed has, the Treasury has, and the US government have is a spending loop that they can't escape. Because Biden doesn't want to embrace a recession, because America is now fighting two wars, let's remember that. Deficit spending has to continue. And it's precisely this doom loop that's freaking out real businesses. Real companies in America are facing higher and higher interest rates. Check this out. 84% of CEOs in American companies all predict that a recession is coming within the next 12 months. These are people who are obsessed about their business day in and day out. They are looking at their balance sheets and they are witnessing a nightmare. Margins are getting squeezed, loan repayments are going up, and profits are crashing down. Then you have the Federal Reserve predicting a 0% chance of a recession. And this is what concerns me. The Fed has been wrong time and time again, especially about inflation. The chance for a recession is well over 0%. So I want to be clear. I'm not saying that deficit spending will end and that will trigger a crisis. Now, what I believe is that the US Treasury will continue to borrow money. The US government is on an endless spending spree, and because of this, borrowing costs will stay elevated and continue to destabilize to hammer the real economy. Now, I hope I'm wrong, but after the events of the last few weeks, we are on a runaway train. A coalition is coming. And just a few days ago, Janet Yellen told the world that the United States can afford military support to both Israel and Ukraine. In other words, the US is going to fund two wars through deficit spending. And what's hilarious is during the interview, she said the US economy is doing extremely well. She mentioned how everyday Americans can certainly afford to stand with Israel and support their military needs. Now, if you're American, please leave a comment below. Let me know if you believe the US economy can afford the debt burden of one more additional war. But Yellen herself has made a startling admission. She just contradicted herself. In an interview, she admits that high interest rates may persist in the US. She knows deficit spending won't stop because of the wars, and this is a big problem. On one hand, you have military spending that isn't going to stop, and this means the US Treasury has to flood the market with a ton of bonds to borrow the money, right? And on the other, it's no longer possible for the Federal Reserve to monetize the debt. Power can't just step in now and print money to solve the problem because inflation is still a big problem. US headline inflation still remains at 3.7%. In fact, prices have continued to rise 0.4% month on month, and that's just the CPI print. If we look at the core inflation numbers, which are the yellow bars, it has risen by 0.3% for 2 months straight. That's stripping out food and energy prices. And if we strip away housing prices as well, that's the grey line, and just consider services, core inflation has risen by 0.6%, and that's the highest increase in 2023. This tells the fact that inflation has now been entrenched. We have now sticky prices and there's no room for them to buy any more bonds. They can't afford to increase the money supply this time by printing dollars. Powell and his merry men are trapped like rats. And now that Biden has pledged unwavering support to Israel, we have to ask ourselves, what will the final bill be? Because it's coming out of the US taxpayer down the road through inflation. And so far, Congress has approved $113 billion in aid to Ukraine since the start of the conflict. And that's a lot of money borrowed from the global markets at sky-high interest rates. And if you think it can't get any worse, well, it is about to. President Biden might be asking for another $100 billion for Israel and Ukraine, another $100 billion of debt, which will spike bond yields further. Now, I know the argument that the US government can borrow as much money as they want, and that's true. But you'll be selling treasuries at increasingly higher yields. The market isn't stupid. If you flood the market with debt, they will demand a higher return to hold on to your paper. And as yields go higher, this is going to push an economy built on leverage to the brink. Now, this has always been an interest rate problem, and you quickly see that the only way to avert this disaster is for the Fed to drop borrowing costs, and they have to do it fast because the market is starting to demand higher yields to buy treasury bonds. In other words, they don't see the value of US bonds at the current rate. In a recent treasury auction, the demand for treasury bonds hit its lowest level since December 2021. Primary dealers had to buy 18.2% of the 30-year, which is a big problem. Primary dealers are your big banks, including JP Morgan, Citigroup, and Bank of America. So all these big boys, they had to swoop in and buy up all these treasuries because organic demand from all the private investors just isn't there. We also know that countries like China and even Japan aren't buying today. In fact, they are selling their holdings. And because of this demand problem, yields are pushed well above 4.8%. And today it's nearly 5% as we speak, guys. So the Fed is trapped. They can't lower rates or inflation will rear its ugly head again. But the story might get even worse. If we look at the data, the economy still looks strong to the Fed, and all indications point to interest rates staying high or going up at least another 25 or even 50 basis points. And let me summarize the recent Fed minutes back in September. It's a glimpse into how Powell and his friends view the US economy. And during the latest meeting, the Federal Reserve shared with us 4 points about why the economy is booming. We know that isn't the case, but this is what Powell is saying. According to the Atlanta Fed, their GDP projections for Q3 is a whopping 5.1%. That's even higher than China. Maybe it's because of all those deficit spending that's driving artificial growth. And we also have record low unemployment of 3.8%. Remember back in 2022, Biden redefined what a recession is, and the excuse was low unemployment. So at 3.8%, this is also a bullish sign for the Fed. Let's also not forget about the phenomenal job gains in September of 336,000. That number is almost double the forecast from all the economists. Even though the majority of this came from hospitality and government jobs, it doesn't really matter. It still looks great to the Fed. And I think you know where we are going with this. The economy still looks strong. You throw in inflation that's almost double the 2% target, we can see that Powell still needs to tighten further. And this is how endless deficit spending just obscures all the numbers. Overall, the numbers look great, but the real economy is already starting to implode. Even if the Fed isn't going to hike further, we can expect them not to cut interest rates until 2024 or even 2025. And according to Goldman Sachs, rates cuts are only coming in Q4 2024. So there's this 12-month gap where bond yields can continue to go higher and higher because of endless government borrowing. And this is already starting to have a material effect on the broader economy. And let's talk about the real economy here. I'm not talking about the defense industry, that is booming for sure, but the real economy, businesses. Because this is where interest rates really do the most damage. Most companies today, they run on debt, they don't use their cash. They either borrow a ton of money from banks or they issue bonds to investors. But either way, companies are screwed. As interest rates stay high and continue to rise, they have to roll over their new debt into high interest rates. Remember that US Treasury bonds set the risk-free rate. So if the 10-year Treasury hits 5%, companies will have to borrow at 7 or 8% easily. And here's why this is a disaster, especially for the next 2 to 3 years. This is a chart of the amount of corporate debt that's set to mature over the next few years. Just in 2023, there's going to be more than $500 billion of debt about to be refinanced at higher rates. Then in 2024, the amount goes higher, hitting $800 billion. And in 2025, we are now facing over $1 trillion worth of debt getting refinanced at a much higher interest rate. If Powell doesn't dramatically drop rates in 2024 and 2025, we are going to see companies literally collapse from higher borrowing costs. Now, you might be wondering how bad can this refinancing get, right? Are we just overblowing things? Is this a storm in a teacup? Well, check this out. The financing costs for the highest quality corporate bonds have gone from under 2% to 6% within 2 years. And for the high yield bonds, debt from risky companies, cost has risen from 3.5% to 10%. So across the board, companies will have to borrow at nearly triple the cost compared to just a few years ago. And this will lead to higher operating costs and lower profit margins. And we all know what companies do if all their earnings crash enough. They'll go on a firing spree. The unemployment figure we see today is just a prelude to the main event if the Fed doesn't cut rates significantly by 2025. And this is where we have to focus on the consumer, because if unemployment rises, people have to either swipe their credit cards or dip into their savings, and the situation is getting dire. The majority of Americans, 80% of people, will run out of their pandemic savings. And this isn't some proclamation by me, it's coming from the Federal Reserve itself. For the majority of all income groups, their excess savings accumulated during the lockdowns will be depleted by Q1 of 2024. The average American saves only 4% of their monthly income. For every $100 they earn, only $4 goes into the bank. Couple that with higher unemployment, this is a recipe for disaster. On top of losing their jobs, people will run out of money to spend. And that's how dangerous having high inflation and high interest rates really are at the same time. A big spending squeeze is coming. In fact, according to the Fed again, 90% of excess savings are already spent. Whatever remains might already be gone in September last month. It's a downhill spiral from here. We are on this endless spending train that keeps borrowing money endlessly, and this is going to keep bond yields high. Remember, Biden is pushing for an additional $100 billion for Ukraine and Israel. A tsunami of bonds is about to be unleashed. Then we have inflation that is still rate hot, so the Federal Reserve can't afford to cut rates either. But it gets worse for the US Treasury market. There's now a shifting demand for US Treasuries. All of the usual buyers are now dumping their bonds, their holdings, and the people buying today, they are demanding higher yields. In a story from Bloomberg, beware the new Treasury buyers, sparking fear in the world's largest bond market. More price-sensitive investors like hedge funds are piling in. And the biggest sellers of Treasury bonds today are the big banks, the Federal Reserve, and foreign buyers like China. And these are buyers that previously bought bonds to fill their books, to stash their money. The big boys, they used to love Treasury bonds as collateral and their piggy bank. But as bond values continue to crash, they want to get out. And the current buyers today are now private investors, people like you and me, insurance firms, and money market funds. And these buyers demand a higher yield. They want a higher premium to finance America's endless deficit spending. And these are bargain hunters. That's why we are seeing bond yields go up higher and higher, even though the Fed has paused hiking rates. In other words, private investors don't trust the US government to rein in spending, so they want a higher yield to fund Joe Biden. It's that simple. But because of this, the US economy is being pushed closer and closer towards a fiscal cliff. Small businesses will continue to collapse, and the American consumer will get squeezed further and further. You can't borrow money endlessly, even if you are the US government. But let me know what you think in the comments below. How much more can Biden borrow? And how much more can the real economy last? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.